So, welcome back, friends. Japanese stocks have surged to new highs following Takaichi's victory, with a renewed optimism taking center stage in Japan. Japanese Prime Minister Takaichi's coalition has secured a historic victory in the 8th February election to retain the seat, having first been elected in October of 2025. After having announced a snap election last month, her victory this week provides her with a stronger majority, potentially allowing the conservative and nationalist Liberal Democratic Party (LDP) to deliver the promised tax cuts and a dovish fiscal agenda. Tokyo stocks have rallied more than 5% in response, with the Nikkei 225 stock average breaking 55,000 for the first time ever. Commenting on all this requires understanding that what Takaichi's return after the snap election can amount to, what is she expected to deliver now. This gives Takaichi a stable majority, reducing the coalition constraints and enabling decisive action on fiscal stimulus, AI, semiconductors, energy security, and strategic reforms. Markets now have a clear fiscal policy runway through 2028 until the next election. Corporate governance reforms, rising return on equity, accelerating dividends and buybacks, and the prospect of strong domestic capital inflows from household savings are gaining momentum, driving a sustained re-rating of Japanese equities. Investor optimism for Japan has been dubbed as the Takaichi trade, fueled by expectations that a prime minister's dovish monetary policies and growth boosting measures such as tax cuts and subsidies will support domestic equities. While doubts remain over Takaichi's ability to implement her plans, given the need to negotiate with independents and coalition partners, her victory has dispelled much of those concerns. Japan was long seen as a contrarian investment, but it is now a reform story with meaningful momentum. The snap election victory has now confirmed that part. Now, while all this is very good for Japanese economy, for its equities, there is a problem for the important yen carry trade. As you know, foreign investors used to borrow in the cheap currency with low interest rates in Japan, and they would then invest in various other parts of the world. Now, if Takaichi is going to have such high growth-oriented policies and has got a dovish outlook, you may see that interest rates and bond yields will indicate that the dovish stance of Takaichi will all yield to an inflation rise in times to come. That means that the interest rates will move higher and the Japanese bond yields would therefore also go up. Once the interest rates start going up in Japan once again, then you will find this could lead to a reversal of the yen carry trade. Therefore, the people who have invested overseas will start bringing money back and investing in Japan itself because they're getting higher interest rates. Also, now there's going to be an extra incentive, extra charm of the Japanese equities also going up. So all this can lead to a tremendous amount of reversal of the yen carry trade and a movement of money back into Japan. That means the investments which were leaning on the rather weak interest rate scenario in Japan, they will not be able to benefit any further. Which means that the risky assets where the Japanese money was getting diverted to will have to return back. Should this gain momentum in the months to come, that can lead to a faster reversal of the yen carry trade. So where you have the Takaichi trade gaining momentum, you may find that a yen carry trade will lose momentum, which is what is good, therefore, for the Japanese markets may not necessarily be good for the international markets. So in this backdrop, we need to proceed rather cautiously. We have to select very, very carefully the asset classes that you're going to invest your money in. And yes, to get to know more about the US markets, the global markets, do join our Prime Plus Telegram group. For the Indian markets, you can join the Premium Plus. For both of them, you can WhatsApp us on 982-086-1044 and be part of our agenda to impart lot of value predictions about how the markets, how various asset classes are expected to perform in days, months, and years to come. Take care. Bye-bye.